views expressed by our guests are their own and do not reflect the official stance of their employer or any affiliated organizations. Welcome to the Council House Podcast. I'm your host, Ken Cook. Today, we're talking with Steve Matthews, the General Counsel at Nasdaq Private Markets, and we're going to understand what liquidity events are for private companies in the secondary market. Welcome, Steve.
Thank you, Ken. Lovely to be here.
Awesome to have you join us. I want to understand what your company does. And if you could, just tell me a little bit about the overall business of Nasdaq Private Markets.
Yeah, absolutely. So we provide liquidity to both private companies and to selling shareholders so that they can realize some of the gains that they've made in their private investment. We will typically work directly with companies to facilitate programs where they can allow for the transfer of securities from their current stockholders, which are typically in large extent of their employee base, and either allow for the transition of shares amongst employees or back to the company, or quite often they will have a new third-party buyer that they wish to have on the cap table, and they will come in and take over some of those previous holdings. So in this case, the company is not actually looking to raise new capital. It is just trying to provide liquidity so that those individuals who wish to exit their positions can then do that in a safe and organized manner.
So you have a company that's growing, you've issued shares out, to the employees, and the employees may be sitting on those shares for some time. And through discussion and upward feedback, they're like, it'd really be great to be able to get some cash out of this. It's been a while. And so this would then percolate up to senior management saying, well, I guess we need to come up with a mechanism to where they can sell some of their shares.
Absolutely correct. And there are a number of, ways that an MPM can help do that. So the most classic example is a tender offer. And this is where either the company instigates an offer to stockholders at a certain price, and they have an opportunity to tender their shares to receive that price. We also have the ability for that to be a third-party buyer. So instead of the company actually doing a buyback, a third party can come in. Maybe they're an existing cap table holder, or they could be a brand new investor that the company is interested to bring onto their cap table, and they will then do a similar offer to the broad shareholder base, and allow those people to tender their interests, all controlled in an organized manner for the company.
So how does the third party buyer work? I mean, does it have to be a matchup to have the liquidity event? If the company doesn't want to buy the shares, back or whatever, they need to find a third party who is interested in buying some shares of a private company.
So there's a number of ways, and we also sort of provide add-on services to this as well. So in the most simple example, the company will have already identified the buyer, will already know the price that the buyer is willing to offer, and will effectively be sponsoring the transition and approving the transfer in that way. And the buyer will typically have external counsel that helps them draft the offering documents, etc., to be involved in that. But MPM does also have sort of two additional sets of services which companies may be interested in. We do also offer what we call capital introductions. So we have a buyer network of around 400 institutional buyers, and we can make an introduction to the company if they wish to avail themselves of being introduced to new potential holders.
Okay, so it may be that a company starts out thinking that they'll do this for their employees and they're just going to buy back the shares, but they may not even realize that there's an option out there to where they could have a third party buy these shares. Obviously, I mean, they don't want to, sell their company or whatever, but I'm sure it's not a controlling interest, and they would be able to have a third party then that has shares that could keep going up. And I assume these things are valued at the time and then valued, on occasion after, on an annual basis or something like that, so that whoever does end up with the shares kind of knows what the value is and all that. That is super interesting. And I think that a lot of companies out there are probably trying to go down this route. And it sounds to me like just from talking with you earlier that there were a lot of events last year in 2024 that you all did.
Yes, so 2024 was very successful. I think just stepping back quickly because you mentioned something about the valuation piece, that we do also do another service where quite often the actual pricing and certainly maybe the company has a 409A valuation or it did a recent series and they know the pricing that they did the series at. But at the same time, they're still interested in what market demand might be. And so what we can do is what we call a buy side auction, where we actually construct a program which is only for potential buyers, maybe third party buyers. There's maybe 7 third party buyers, say, who are interested in potentially taking forward a tender offer for the stockholders, but they're equally not quite sure what the clearing price might be or the price to get the most interest. And so we can run a private event where each of the buyers, puts in non-binding indications of interest for the amount of shares they would be interested in purchasing at a particular price. And we run an algorithm, usually sort of a modified Dutch auction, where we will come up with a clearing price which will clear what we believe the anticipated supply will be, which the company's helped us generate. And that will create a price, and the company then can make a choice as to whether to engage these buyers at that price and say, would you be interested in running a tender? And so they can do that. But going back to 2024, yes, thankfully 2024 was a very good year. I'm not 100% sure how many programs we ran, but I believe it was over 80 for private companies. The previous years had been more tough. The environment was bad for a number of reasons. But yes, 2024, we saw the private markets come back, companies being interested in liquidity, investors being interested in reallocating capital to the private markets. And so it was a positive year for us.
Tell me a little bit about the companies that get to the point where this is, this is something that they want to, partake in. Is there an average size? I mean, we talked before about the size of companies, the growth trajectory, the industries, things like that. But like, who are, would you say, the the companies? Like, what's the profile? I guess is what I'm looking for of the companies who are ripe to have an event like this.
That's a good question. I think what we're typically seeing is sort of Series C onwards. Late stage companies will typically, pre-IPO will be the biggest programs that we operate. There's usually a desire for liquidity just before an IPO because there's quite often lockups at the IPO stage. So that's where we see that. So they've got to a critical mass where quite often it's either the founders themselves being interested in liquidity and saying, look, the founders or the C-suite being interested in a program and they want to offer it to the whole employee base that has been on the ride with them over the years. Or it can be at a point where the company is mature enough that their own employees are sort of asking, as you mentioned in the introduction, asking about the potential for liquidating some of their or monetizing some of this equity that they've built up over the years. And we have a sort of a saying internally. So you've earned your equity, now realize it, basically, where we want these people to have this opportunity.
So we talked about some participants, employees, uh, late stage private companies. Talk to me a little bit and just explain a little bit about, institutional investors and early stage investors.
So traditionally, we have had more activity around institutional buyers. We are finding that actually retail buyers are becoming more and more interested or sort of inquisitorial about the private markets. They're looking at other asset classes to invest in. We're seeing that through funds as well, being more interested in these alternative assets, these private company shares.
What do you think drives that interest, the increased interest?
It's really an untapped market. So a lot of times it can be simply diversification. It can also be particularly in market volatility in the public markets, it can be looking for alternatives which might maybe cover some of the risk in the volatility that they're seeing in the more traditional asset classes. Um, and it's also seeing the fast uprise in some of these well-established private company names. The sort of the poster child is SpaceX. People are interested in that company. They're interested in the division it's in. They're seeing how it's interacting, with the NASA's of the world, and becoming more and more of a force in the space sector. And so people are wanting access. And it's people being inquisitive and looking at those options.
And I think I heard a quote, it's several years old now, so it may not be accurate anymore, but I think Elon Musk said a number of years ago, I'll take space. He was really anti IPO at the time, and he said, I'll take SpaceX public when we get to Mars.
Yeah, and I think that's a sentiment we're actually seeing a
Yeah.
lot in the private markets. And it's maybe, of course, there's the strategic direction that the senior management want to take the company. But there's also the reality that, these companies are performing well in the private space. They have other access to capital. They do not need to use the IPO route maybe as early in their life cycle as we've seen traditionally. And I think we're sort of seeing a move really from where private companies would stay private for 7 to 9 years. And now we're seeing it more like 11 to 13 years.
Okay. Okay. And I assume early stage investors, they just want to get their money out or a portion of their money out. If they've invested super early, then they would be interested in a liquidity event to get some of that investment back.
Absolutely. And, these entrepreneurs are also looking at other options in the market. New companies are coming up. Maybe they were wishing to diversify themselves. Maybe they're very hot on a particular sector and they want to realize some of the gains they've made, or narrow some of the losses they've made in a particular investment and reallocate that capital.
Talk to me about the evolution of NPM in response to these longer private company life cycles.
Yeah, so we're in a relatively narrow field in terms of the other providers out there. Certain firms have taken a different track and have different services they offer. I think what we're finding is, the core of the business is still sort of the classic tender offer or other company-sponsored liquidity events. But we've, over the years, recent years, we've branched out into other areas as well. We now have what we call a capital markets business, where we are looking to match sellers, individual sellers, be they institutional or employees, with buyers who are interested in taking their share. So sort of in the public markets, you'd maybe call it a block sale. We're also seeing an interest in sort of, I'd say, additive products and services around those core topics. So last year we launched a trading and settlement, uh, process. So again, in the private markets, you don't have the typical clearinghouse or clearing broker or central securities depository that helps for the movement of these shares. It's really a very manual process. So people either will have a stock certificate, they will need to work out how to have money wired to them if they're selling from the buyer. They will need to make sure the companies approve the transaction, and they'll also need to work through the legal documentation and also updating the cap table with the new investor. And so we've built a process to help companies with that. Again, it used to be very administrative. The companies would have to do this, and we now have a streamlined process where once a buyer and seller have been identified, the company will communicate that to us, or we'll have learned it in the first instance ourselves. We will then work with the company to get any transfer approvals finalized. We will work to get any documents executed between the buyer and the seller, and we'll actually arrange for the wiring of the money from the buyer to the seller, so that's a streamlined process. And at the back end, update the company and the cap table to identify the new buyer on the cap table. So that's one area where we've seen a lot of development and an evolution where these added services have been really, really interesting.
So one-stop shopping.
Yeah, and I think that's what we're going for to some extent. Now, there are certain areas like cap table provision that we haven't stepped into as yet. There's a number of firms out there who are dominant in that space. I think we are starting to look at other additives like market data. So that's an area where there isn't a great amount of transparency. The companies are very cautious about sharing data about their company and the trades and the valuations. We have a product that we're building at the moment, which is designed to create pricing information in the private company space for typically the most interesting, I guess, or most liquid names are about 170 companies. So we're looking at prioritizing that first and making that available to institutional investors, to the issuer themselves, to stakeholders like the employees of companies, to see what their stock is worth and what is going on in the broader market in terms of transactions.
That's awesome. Talk to me a little bit about SPVs.
So this is a new area for us. It's not necessarily a new area in the industry, but what we've also found is that for multiple purposes, some parties don't actually want to either end up holding the actual underlying private company share. Maybe there's transfer restrictions. Maybe there are informational um, uh, rights that they don't gain from those shares, and so they're really looking to have the economic exposure without some of the other tails that occur with the equities underlying. So we've had people come to us and ask us if they've recently come to an agreement to purchase shares. Instead of actually receiving the shares directly, can we help them put them in an SPV and sell LLC interests to them or the counterparty? And so we have a mechanism now to do that. We work with a third party that helps us spin up these SPVs very quickly. And one of the benefits there is that when they do wish to um, sell their economic exposure, they're not having to go through the process of getting the transfer approvals from the company, which is we can come on to later, is a protracted process, and they can potentially liquidate their interests quicker and allow for the transfer of risk on a lot more accelerated basis.
But the underlying investment is the shares of the company, which is cool. So it gives more access
Absolutely.
to these without having to go through the transfer approvals and all that kind of extra, bureaucracy and paperwork.
Yeah, and I will add though, we are very much NPM's very much aligned with issuers, so we are not looking to do this without the approval and or knowledge of the companies themselves. We're actually working to, you know, purposefully identify that we're interested in this area and work with those companies to make it an additive value add for them. There are also benefits for the company directly. For example, if they do have a number of smaller employee shareholders who maybe their individual holdings would not be large enough to attract an institutional investor. This SPV mechanism allows those sellers to be pooled into the SPV and then the block to be bought by a third-party provider. So there are ways we are purposefully looking to align ourselves and work closely with the issuers to offer this product.
Do you see any future where there's an SPV create with more than one underlying company in it?
At this stage for MPM, no, but clearly those exist elsewhere in the industry. The fund industry and alternate investments is prevalent. Our colleagues at Nasdaq actually have a product suite designed to do exactly that. We are looking only at this stage at single company SPVs.
Can you talk to me a little bit about types of liquidity programs that you've discussed a little bit, but how do they compare to like IPOs, direct listings, and SPACs?
Yeah, so these are really sort of in a sense private events, right? So this is all of the programs we offer are very much, when I use the term company sponsored, they are with the permission and approval of the company. So uh, we talked about earlier like the tender offers, the uh, price discovery process, buy side auctions that we can work on, the cap intro. The two other areas where I guess you see more like an exchange or a market would be in areas where we're looking at creating continuous trading or windows of liquidity is what we call them. And this would be a private event again that the company sponsors or authorizes, where individuals can go in and within a certain time period buy and sell shares in a controlled environment on our sort of platform. We use our ATS to do that, our alternative trading system, which is regulated by the SEC. But it is still a private event. So the company controls who's allowed in. They control some of the parameters around how these shares are to be traded. So they can designate the total number of shares that can be transacted or the minimum order sizes. They can help with a minimum or maximum price. They can help with the dollar denomination that each trade has to happen at. So in other words, you can only trade in 5-cent increments, all of that kind of stuff. And we can run this program and then match up the interests and either clear them all at one price or clear them at bilateral prices that are agreed through whatever rules we construct.
Wow.
So it looks like like you'd see in more of a public market.
Yeah.
But we're doing all of this obviously pre-IPO. So the IPO is obviously the general offering to the public, where a certain amount of the equity is created on the public markets. It creates lots of disclosure and other obligations on the company. So it's not necessarily the first way of raising capital, but for the very mature companies, it's the most obvious. Direct listings again allow a firm to access the public markets quickly, where they're not actually looking to seek to raise more capital, but just put their trading shares to be traded on a public market. And then SPACs, the special purpose acquisition companies, are typically where a company is constructed. It's really like an investment tool where people will come together. They will fund the SPAC, and then the SPAC will then purchase the company. And it's in essence, it's an SPV type structure.
Is this, to me, like, and correct me if I'm wrong, but this seems like it may be a stepping stone to ultimately IPO
That's absolutely what it is.
in growth, in their growth
Yes.
trajectory. I mean, I wouldn't imagine that there's, a large percentage of companies that IPO that have not done this or gone through this.
Yes, I think that's true. I think there is usually at some point either one or more events in the pre-IPO or pre-public market life that a company will go through where they wish to offer liquidity. Because otherwise, really, unless you either IPO or you have a buyout, there is no obvious exit for the shareholders and no liquidity where they can realize some or monetize some of the interests that they hold. So at some point, we typically have this conversation with a company. Some of those do wait longer in the process, but as I alluded to earlier, because we're seeing companies stay private longer, liquidity ends up coming up in conversations more earlier in the process and probably
Mhm.
on a more frequent basis.
I know you're not gonna be able to tell me a rough a rough average, but I'm gonna ask anyway. Like, how many years on average from the beginning where the employees are getting shares and things like that does this come up? Is it 2 years, 3 years, 4 years? How long are the employees hanging on to this stuff before they're like, "Hey, we'd like to get some cash out of this?"
It's a difficult question, and I'm going to speculate, but bearing in mind we typically talk to Series C investors at the first stage, um, you're looking at possibly 12 to 18 months each series.
Okay.
So maybe at the earliest, probably at the 3-year mark,
Okay.
but it could be later. And as I said earlier, the earliest private company is the most successful, sort of looking at IPOing in a 7 to 9 year window, although that's now more and more uncommon. But you could say sort of the 3 to 9 year mark is where we start seeing this activity.
Let's switch to market trends and talk to me about the current demand for secondary liquidity among the private companies out there.
Yeah. So what we're seeing is there are a lot of private companies out there, obviously, but as I mentioned, we're the most active are around the top 170. Where we're seeing really the heavy demand is in the top 25. And so those are the names that come up regularly. Those are the names that there's typically always high demand for. And so those are the most active. Some of even the names after 25 can become difficult to find liquidity for. Maybe there's less information known about them. Maybe there is simply less demand. But those top 25 names are very active, and they, at the moment at least, tend to sort of crowd into a number of sectors. Crypto, very popular. AI, incredibly popular. Um, Data centers, we've seen a lot of activity in data centers. And then sort of the aerospace industry generally, like the SpaceX example I gave
Yeah.
earlier.
Okay. That's great. What do you think the pipeline is going to be for 25? And again, I mean, if you don't want to speculate, that's fine. But it seems like there might be, could be more movement in 25 potentially than maybe even in previous years.
Yeah, and again, absolutely, you know, l- speculating here. I think what we anticipate, and this is based on public information, is that it looks like the IPO market or the IPO, there's a robust pipeline, but it's in certain sectors. So, from certain documents which have been filed, the S1s that have been filed, CoreWeave, Klarna, um, uh, Chime are names that come up regularly as firms that are now on the IPO calendar. Um, so again, we're sort of seeing probably a level of robustness in the industries that I mentioned. Um, there are other industries, but also which don't typically make up the bulk of the private market anyway. But there are other industries that you know may not see as large an uptick, particularly those I would say retail, food, auto, where certainly some of the administrative changes that we're going through may be more susceptible to tariffs or other areas or labor costs. Where we may not see that growth. But we're certainly in those sectors I mentioned, we're seeing activity.
Talk to me a little bit more about the macroeconomic conditions, interest rates, inflation, market volatility, et cetera, on the private company strategies around liquidity.
Yeah, I would say more generally that the way we've seen the correlations in certain activities with how the private markets perform generally, um, we do see a positive correlation where there's a robust IPO market, not necessarily a upward trending stock market. So it really is the launch of IPOs and capital being raised by those companies and liquidity events in the companies below them, who we work with, then being more of a prevalence. I think there's also a sort of negative correlation with interest rates. So we do see as interest rates go up that companies find it more difficult, liquidity becomes tighter, maybe there's less interest and activity in running these programs. So those are the types of things we see.
Let's move on to the meat and potatoes of our talk here at Council House, which are the legal and regulatory considerations. What kind of legal issues do you have to navigate on a daily basis? I mean, it must be crazy with all the regulatory scrutiny and legal scrutiny and all these things of a company like yours.
We have like regular touch points in certain areas. It is a relatively niche area or industry to be in. It is part of the securities industry, but it's a subset of that. And so, on the company program side, we quite often come up against, is this a tender offer? What is a tender offer? How is it defined? There's no strict definition of a tender offer. So we work a lot with external counsel on programs that we might be helping a company construct, be it what we could sort of consider a more plain offer, by a large shareholder or by the company themselves to a certain number of parties and running it for 20 days and doing the sort of the tender offer process. But we also work quite often with, companies that want to do something slightly more elaborate. So they may want one of these continuous trading windows, and what rules apply there. What are the rules of the ATS? How much discretion does the company have versus MPM as the ATS operator? And so we'll work with counsel on those, what disclosures are required, etc., and the documentation that attaches to that. Um, on the capital market side, there are a number of rules about, how you interact with accredited investors, whether There's foreign jurisdictional issues because we do have parties interested in buying and selling shares who are not based in the US. So that's a hot topic of conversation. You know, are we allowed to have them participate in a program? Are we allowed to? Maybe they can participate, but maybe there's a rule about wiring money to them in their jurisdiction. So we have a number of areas there. Even if we are allowed to do a block sale for them, are we allowed them access to our ATS? Because the regulations for those parties in an ATS transaction differ because of the regulatory overlap. So those are the types of typical questions we get. We've also just stepped in with the SPV business, stepped into the investment advisor space. We've set up we're in the process of setting up a registered investment advisor. So that's going to, again, create additional disclosures, processes for interacting and providing investment advice or soliciting parties to interact in that area. So those are the areas where you regularly get a lot of questions.
That's exciting. I didn't know that you were, registering to be an actual investment advisor too. So that's fantastic. But more headaches for you, probably more paperwork.
Lot of paperwork.
Oh boy. All right. So talk to me about since we talked about investment advisors, talk to me about the regulators. Who are all the financial regulators and everything? I mean, is it pretty much all of them?
So no, I mean the front line for us is FINRA. We
Yeah.
have a broker dealer, so that's our main sort of point of contact for the both the ATS and for the investment advisor is the SEC.
Yeah.
So those are the core. But there also a number of these areas have state requirements over and above the federal requirements. So we are registered in the 50 states. We for certain of our business. Paying agent services, i.e. the transmission of money, is typically state regulated. So we work closely just to make sure we have a sort of a benchmark standard that covers the requirements in each of the 50 states. But as I touched on, also we have to keep an eye on foreign jurisdictional requirements. So just for example, if we want to work with a UK company or a UK investor, what do we need to stay away from before we step into regulated activities in those jurisdictions? And, other than Canada, we don't strictly have a license. We don't have a license in other jurisdictions. So we want to work very carefully in the area that is safe, that we're not stepping into a licensing issue that we might accidentally stumble across.
And what about for, investors that may be in countries, let's just take China, for example. I mean, there's obviously, scrutiny and concern over China for all kinds of reasons, and tech transfer, and all these you know uh, safeguards we're putting into place, or have been being put into place, just on foreign investment, and like CFIUS type stuff, is what I'm thinking. But like, is it, aside from all the typical, European countries and things like that, where do you see most foreign investment coming from?
It's again a good question. We get a smattering from all over the place. We do have a number of interested parties in the EU, in the UK. Certain parties have set up entities in for the likes of Cayman Islands or BVI, or Bermuda. So those names come up regularly. There is a general significant interest in the Far East. So Singapore, Hong Kong, China, those areas again, Japan, sorry, come up. So we get a core crux where we have a lot of queries come in, but I think overall we've had a situation to get external advice on probably 20 countries.
And we talked a little bit, I think, previously. Well, you mentioned the SEC just a minute ago, but talk to me about its 2025 examination priorities, and kind of like what you see going on, in this administration with this SEC that's coming up now.
Yes, so in the SEC's priorities, they did flag the private markets as being of interest, particularly trading practices, um, managing conflicts of interest, sales practices. So those are areas we're expecting to get queries as well. Um, I think there's still, to some extent, um, an educational gap between, the more familiar public markets or asset classes. And as I alluded to very early in the conversation, there is still very much a manual process for a lot of this. So, where in the public markets, they're talking about T+1 now, and you have infrastructure and processes to manage the execution, clearing and settlement of transactions. That is still very much manual and rudimentary in the private market. And so some of the challenges we face as a firm, again, sort of touching on sort of maybe not legal risks necessarily, but operational risks. We do, there is a pain point, between a trade being executed where a buyer and seller have agreed to core terms and actually getting the money transferred from the buyer to the seller.
Yeah.
And so, there is a typical process will be where, the company needs to be messaged about the potential transfer. They then need to take time to consider whether they want to allow that transfer. Most companies have an absolute right to prohibit a transfer if they don't wish it to go through. Um, they may have well, actually, in almost all cases, they have a right of first refusal, so that the company can choose to step in and buy the shares instead at the price that's been agreed. Or they may have rights to substitute the buyer for a buyer of their preference.
Hmm.
So there are a number of these processes that they need to go through. Some commit in their documents to trying to process this decision making within 30 days. Others need to wait to the next board meeting, which could be on a quarterly basis. So you can see, even once that then comes back, the documents need to be executed between the buyer and the seller, and payment information needs to be exchanged so that the wiring of the money can occur. So that can be very protracted. And in every step of that process, because of the uncertainty and the time, one or other party may wish to walk away or try and find a reason to exit. So that has been a frustration in the industry generally, um, and we're working with others in the industry to try and automate that process, speed it up as best as we can to take some of that lag risk out of the system. Um, Other areas we see, sadly, is just bad actors where, because of this delay and the fact that there is no legally binding commitment once you agree to a trade,
Mhm.
and no collateral that needs to be posted or deposit that needs to be posted to back that trade. Um, People may just agree to a trade, maybe with no real intention of sort of proceeding with it, but almost giving themselves an option on
Hmm.
that trade, while they still search around if there's a better trade out there.
Interesting.
So
So
that's something we're struggling with as
is there not paperwork, letter of intent, anything binding at all to sort of bind these people into, because their interests and stuff could effectively cause a lot of work that needs to be done. And yeah, I'm just a little, I guess I'm a little surprised that there's nothing that binds them to do that.
So we have looked at alternatives to try and improve this process and take some of that risk out of the system, and we're still working through this. We have legal agreements with our buyers and sellers where we make it clear that, even if you end up not having a contractual obligation to the other party, the fact that you walk away from a trade is seen as bad form by us, and we reserve rights to either charge an administrative fee or to simply say we're not going to provide you services going forward. So we as a platform are trying to clean the market in that sense.
Yeah.
Um, what we've seen, though, the most obvious example would be to have something like a stock purchase agreement, which is a preemptive agreement in place where you're agreeing that at a future point you will buy the shares, subject to approvals, et cetera, et cetera. And then at this time the actual transaction is consummated, you sign a stock transfer agreement that is usually a form provided by the company themselves. Um, we've looked at that stock purchase agreement as an option on the front end, and the market just doesn't want that right now. They don't want to enter into that. So buyers and sellers themselves are the ones pushing back. So that is another option. We've also toyed with, earnest money deposit type of
Mhm.
examples where, and we know one of our the other platform providers in the market does require an upfront deposit to be made, and we've looked around options like that to try and help encourage the transaction to complete. But it's difficult because, again, this is a market where those are, even though they may be the norms in the public markets, they're not and haven't existed in the private markets, and it's still a difficulty to get people to come around to that type of thinking.
Do you think it's headed that way though in the future where there'll be the earnest money or the, you know, the administrative fees or whatever if you just walk away with no good reason? I mean, do you think that will eventually become the norm? Because it seems odd to me as a layperson that you could get into this and say, "Oh yeah, I want to do this," and then, like the bad actors, just you're still shopping around and you're looking for the best deal, and you really had no intention of doing
Right.
this.
I think if the market doesn't come up with solutions, the regulators will.
Yeah. Okay.
And so, we're active in this space. We're keen to find ways to improve the market, to improve the execution quality, to improve the information out there, the transparency of data. So we're keen on bringing those to the market. As more and more retail customers become interested in this space, I think you'll see a regulatory appetite to better understand the market, look at the risks, maybe even implement rules and procedures for these markets. Depending on also their own priorities that they have in other areas of the financial services industry.
What are some of the other legal risks for buyers and sellers in the secondary market?
So yes, this is a good one, and it's again it builds on some of the points I've already mentioned. So one of the classic areas is there's just lack of information.
Hmm.
So you may wish to invest in these companies, but these companies are not required to provide any information. And in fact, unless you're a preferred stockholder, maybe there is no information rights at all. So quite often, even when a seller comes to the market, they may actually not have any information to provide to the buyer about the underlying company. Or they may have it, but they may not be able to provide it as they're under a confidentiality agreement. So buyers are typically at risk of really buying an asset unseen, other than what's available from the public supply of information. So we regularly get questions about that. We you know, effectively disclose that that's a potential issue in our documentation to buyers and sellers. There may be an information imbalance. There may be no requirement to provide any information. There may be no information available. Even if we've been given information, we as a platform provider have no ability to validate its accuracy or completeness because we don't have rights ourselves to get the information. So we try and just call out that this is sort of buyer beware. You need to be conscious that there are risks associated with this asset. And I think that's also part of the reason there hasn't been until recently a real retail desire to really step into this space in a big way.
Yeah.
So that is one of the core issues. Linked to that is just a lack of pricing information. So again, private companies are not required to produce unaudited financials, management information. They may have obligations to certain stockholders in their stockholder agreement, but typically they're not required to provide that. Even if we are aware of trades, just say we ran a tender for a particular company and it cleared at a particular price, typically our documents say that we aren't able to advertise or disclose that price. It's a private piece of information. So, buyers and sellers coming in, they may anecdotally learn of what trades have happened in the market through sort of people talking and giving market color, but there isn't, unless there's something filed with a state regulator, which does happen, periodically, and certainly if there's a series investment, there'll be a price attached to that. That pricing information is not available. So that is another area we're seeing sort of concern. And as we talked about earlier, we're trying to come up with product Tape D that will help in that space and provide some form of transparency to pricing information. I think finally, we've talked about the bad actors. We've talked about, issuers really ultimately controlling the whole process. So, so there can be an issuer can simply block a transaction without needing to give any reason. And that can be, a frustration. But also the standard documentation. Although stock purchase agreements, although stock transfer agreements do typically follow a simple form or a standard form. There is no uniform documentation. There's no uniform process for clearing and settling the trades. And so that has, depending on which platform you use, depending on whether you do this bilaterally, depending on the company and what they want to do, all of these things can vary. And that lack of uniformity sometimes causes confusion or frustration. And there's no obvious way of that being sort of harmonized.
So what are the typical mitigation, um, risk mitigation efforts that companies will go through, buyers will go through to, you know, get their due diligence? I mean, obviously, if it's a company that's well known and it's in the media and things like that, you know a little bit more, and then you have an independent valuation. But is that, I mean, and just as a layperson, like, is that it, or can they, if the company really wants to do this deal, the seller really wants to do the deal, can they disclose more? Or are they prohibited? Or can the two parties get together and say, okay, like, open up all your books and everything and let us take a look? Or is that just usually not?
I mean, maybe they could, but they don't.
Yeah, they don't.
So
Because they don't have to.
yeah, don't have to. I mean, what we do find is, a lot of these investors that have been in this market for a while are very sophisticated. They have
Okay.
their own data sources. They found, collected information over the years themselves. They have certain tools. You can, there is information available at each of the state registers. So, if the company's a Delaware LLC, you can go and you can ask for all of their corporate documents, and that will sometimes contain, or include updates to a shareholder agreement that will tell you the last series and the price that the series was priced at, and the
Okay.
number of shares. So there are sources.
But it's still somewhat of a gamble.
Yes, absolutely.
Yeah.
We, again, at MPM, we're building out this product Take D, which is trying to consolidate various information that we found mostly from these public registers, but also market sentiment, any other information we've been able to and can legitimately use to add to the mix to create what we believe is a current trading price or market price. But even then, there's quite often a range. I would say that range has come in significantly for the top 25 names, but there can be disparities that, particularly in the smaller names, that still add to that sort of lack of transparency and confusion.
Well, Steve, this has been fantastic. Thank you so much for coming on. The way you explain everything makes a very complex topic, easier to understand, and certainly understand the attractiveness of this for all the parties involved. I mean, it seems like a win-win. I'm thinking that 2025 is going to be a great year for you and a great year for NPM, obviously. And we really appreciate you coming on the podcast and sharing with us.
Now, I really appreciate this opportunity. It's been fabulous. Thank you very much.